Enbridge just reached $80 per share, an all-time high, while carrying a legal risk that the market had formally retired from its pricing models. That combination is not typical of a defensive, regulated pipeline yield play, which is exactly what Income Capital bought when it entered this position over the past 2 years. The prior thesis was built on 3 pillars: take-or-pay pipeline contracts generating durable fee income, the 4.8% dividend yield as the primary return proposition, and the 2024 acquisition of 3 U.S. natural gas utilities as a cash flow stabilizer. That thesis produced a 26% gain over the past 12 months, compressing the yield even as the underlying cash flow story remained intact. But the capital that drove that 26% move was not the same capital that originally bought Enbridge for income. Income-oriented participants entered at a yield point. The price appreciation they received was a byproduct of a positioning shift by a different participant class repricing the asset on a new forward thesis. The positioning shift is visible in the timing. The $75.19 level reported on May 20 cleared to $80 by May 27, a move that coincided precisely with the announcement of 2 direct energy contracts with Meta platforms. That timing structure, price clearing to all-time high while 2 hyperscale energy contracts are announced, signals that growth-oriented capital repriced Enbridge faster than income-oriented capital had time to reconsider its position. The participant class that has not yet confirmed the move is the income yield cohort that entered below 65, which now holds a position repriced on a thesis it did not originally underwrite. The unresolved question that 80 leaves open is whether the free cash flow per share growth, guided at 3 to 5% annually through 2028, is sufficient to support the new price, or whether the growth capital entered ahead of the fundamental delivery.
The reason the thesis changed is not simply that data centers need gas. It is that Enbridge signed a named contract with a named hyperscale operator and then signed a second one. The Cowboy project is a natural gas supply infrastructure deal designed specifically to fuel Meta Platforms' AI data center operations, announced May 20. 6 days later, Enbridge announced a separate $1.2 billion solar and battery storage project, also for Meta's data centers. 2 direct energy supply contracts with the same hyperscale operator, combining gas and renewables, executed within a single week, is not a sector tailwind story. It is a named counterparty relationship that converts Enbridge from a toll road infrastructure company into a direct energy supply to the AI buildout. The distinction matters for capital allocation because toll road infrastructure is priced on regulatory certainty and yield, while direct energy supply to hyperscale operators is priced on contract duration, counterparty credit, and volume growth. Growth-oriented capital entering on the AI energy supplier frame applies a different multiple than income capital applying a yield floor, and the $80 price reflects that multiple expansion, not a re-rating of the underlying cash flow. The countersignal that growth capital has not fully resolved is this: the $1.2 billion solar project is a capital deployment commitment, and Enbridge simultaneously executed a debt swap that analysts noted increased total interest cost marginally. A company deploying $1.2 billion into a new asset class while absorbing marginal interest cost increases is not a risk-free thesis upgrade. It is a capital allocation bet on the AI demand curve sustaining. The confirmation trigger for the AI supplier frame is whether additional named hyperscale contracts, beyond Meta, emerge before the 2026 capital program closes, because a single counterparty relationship at $1.2 billion scale does not yet constitute a diversified growth layer. The New England Pipeline expansion proposal, targeting northeastern U.S. gas capacity for AI data centers and gas-fired power generation, is the geographic extension of the same thesis, but it remains a proposal, not a contracted revenue stream. What the Meta contracts establish that the New England proposal does not is a named counterparty proof point, and that difference is precisely what the growth capital priced at 80.
The risk that growth capital discounted when it repriced Enbridge to $80 is the same risk that income capital had been carrying for years and had been told was substantially resolved. Line 5 carries roughly 540,000 barrels per day of crude oil and liquids across the Great Lakes. It is not a marginal asset. The tunnel reroute project was positioned to Enbridge investors as the definitive solution to the multi-year Michigan shutdown dispute, converting an existential threat into a managed construction timeline. A Wisconsin federal judge's pause on in-water construction, applying specifically to the Wisconsin waterway portion of the tunnel project, does not reopen the Michigan shutdown threat directly. What it does is inject scheduling uncertainty into the one mechanism Enbridge had used to guide investors away from pricing Line 5 as a tail risk. The market did not reprice sharply on the judicial pause. The stock was at a 52-week high on the same day the ruling landed, which means the pause entered a price structure already elevated by AI contract optimism. That sequencing matters. When a new negative catalyst arrives into a price already carrying elevated growth expectations, the combined exposure is larger than either factor alone. The threshold that converts the judicial pause from a scheduling delay into a repricing subtlest is whether tribal and environmental litigation expands beyond the Wisconsin waterway injunction to challenge the tunnel permit itself. If the pause remains a Wisconsin construction halt, Enbridge absorbs it as a timeline extension on an asset already generating revenue, the pipeline continues operating while the reroute is delayed. If the litigation surface extends to the Michigan permits, the resolved risk framing that income capital accepted collapses, and the position pressure that originally drove income capital out of the stock at yield compression points does not have a clear relief valve. The 4.8% dividend yield at $80 per share means the income return the original thesis promised is now priced into a stock carrying both AI growth expectations and a re-emerged regulatory tail, and only one of those three things was in the original allocation thesis. The monitoring variable is not the next court date on Line 5, it is whether the participant structure around Enbridge shifts further toward growth capital before the judicial outcome clarifies, because if it does, the downside scenario when Line 5 uncertainty persists is amplified by the positioning imbalance, not just by the legal result. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.